Hello investors and future investors, welcome back to the channel. In today's video we will be trading using option strategies that can be used for small accounts as well as can be used during a recession. Now if you're new to the channel, thanks for stopping by. On this channel we help you with option strategies and other investments that can give you consistent revenue. We can all make weekly revenue if we want to, so I'll definitely show you what I'm doing on my end to generate more revenue. Now, all I ask in return for this free content is an early thumbs up by you hitting the like button and consider subscribing for more ways to increase your investments. Welcome to Investment Gains. Let's jump right into it. Now, as promised, I did say I'm going to start this account off with $2,000. So let's jump right into it. For today's strategy, I'm going to be using the Spider ETF, ticker SPY. So let's go ahead and open it up. And as usual, we're going to be going into Trade SPY options in order for the options chain to load. Now that the option chain has loaded, now we're going to start our strategy. Now this strategy involves two parts. So let's get right into the first part, which includes selling a call. Now, to sell this call, we're going to use our expiration date of July 20th. Now, we will be choosing our strike price above our current share price, which is now 383.01. And I will be going with the strike price of 387. Now, we're selling a call. So once we sell something, we will be receiving money. Now, the amount of money I will be receiving for this is going to be 0.74 or $74. As you guys well know, each option contract is multiplied by 100 shares. So let's go ahead and click into this. Now you may be asking yourself, why did I go with the 387 strike price as opposed to 386 or 388? This is all based on your personal preference and your risk tolerance. For me, I like to choose an option that has a chance of profitability of 75% or higher, and as you can see on this one, there's an 82% chance. I will every now and again go down to a chance of profitability of 70%, but never any lower than that. So this is the first leg. Okay, so now we're going to go to the second leg of this strategy, which is going to include buying a call. Now we're going to use our same expiration date, which is going to be July 20th. And now we're going to choose our strike price above our sell price, which was 387. So that's going to be 388. Now, since we're buying now, we're going to have to pay. The amount we're going to be paid is going to be 0.55 or $55. Now, as you can see up here, it's called the call credit spread. Now, the call credit spread can be used if you're trading with a small account because of the ease of entry. And I will show you that in just a second. Now, this is called a call credit spread for three reasons. Reason number one, it's a call, meaning we use a call. We use sell call and then we also use buy call. The second part of this call credit spread is the credit. The credit means that once you do this strategy, you should be receiving some kind of compensation. In this case, it will be money going into your investment account. Now, the third part of this is the spread, which is the most important part. The spread is the difference between your two strike prices. Now, the spread on this is going to be between 387 and 388, which is $1. Multiply that by 100 shares, which is going to be $100. Now, I will show you the importance of the spread in just a second when we go over to the collateral. So now we're going to go ahead and we're going to go to continue. We're going to choose the amount of contract, which is 1 for this instance. And we're going to choose our limit price. We're going to use Robinhood's suggestion, which is 0.21. We're going to hit review order and voila. So let's get back into the spread part. Now, because the spread here was $1, which once again is the difference between 388 and 387, multiplied by 100 shares, that gives us now our collateral. So in order for you to do this trade, you must leave a collateral of $100. Now, I'm pretty sure most of us here can afford a collateral of $100. So your gain on this is going to be $21 right away. Once you do this strategy, you will be receiving $21 minimum credit into your investment account. Now, that money is yours no matter how this trade goes. Now, your maximum loss on this trade is going to be $79. Now, how do you come up with that? It's going to be your $100 collateral minus your minimum credit. So how do you win this trade and how do you not so win this trade? Well, the reason why this is a good option to use during a recession, in my opinion, is that if you think that a stock is going to continue to go down and not go up, this is one of the best strategies to use. What you're actually betting on this trade is that SPY come July 20th is going to be at 387 or below. Now, I absolutely love using call credit spreads, and the reason is because of the low barrier of entry, which is only $100 to get into this trade. Now, for those of you out there that wish to grow your account very aggressively, there's several ways in order to increase your amount of minimum credit in which you're going to be received. So let's go back for just a bit. One of the primary ways to increase this is to increase your amount of contracts. So instead of putting 1, let's do 3. So 3 is now going to give us $63 credit. However, your collateral will increase. Now, your collateral is going to be $300. Now, once again, trading with a small account, you should be able to afford $300. So another way to increase the amount of minimum credit you receive would be to increase your spread. So let's go back to 1. And now we're going to change the spread. So by changing the spread, what I mean, instead of doing 387 to 388, which is going to be $1, you can increase your spread by doing $2. So you're going to go between 387 and 389. So let's remove this and we're going to go to the 389. Now right away you see your minimum credit is going to be $36 as opposed to before, which was $21. Now this is only to be used if you're trying to grow your account very aggressively. I would not recommend you doing 3 contracts of the same stock. I would highly recommend you diversify. So for instance, you could do 1 credit spread on SPY ETF, another credit spread on QQQ. Just my opinion. Now, the call credit spread, like I said, is perfect for the recession. Now here is the number 2 option strategy I think is perfect for a recession. So for this, we're going to be using MARA, ticker symbol M-A-R-A. So let's go ahead, we're going to open it up. And now we're going to use a different strategy. This strategy can also be used during a recession and can also be used if you're trading with a small account. So let's go ahead, we're going to open up the MARA options chain. And now we're going to be selling a put. So we're going to go to sell and put, and we're going to be choosing our expiration date of July 22nd. Now this case, we're going to be looking for our strike price below the current share price. Now I'm going to be going with the strike price of $10, which is directly below the strike price, and for that I'm going to be receiving $87. Now the reason I'm choosing the $10 strike price is, once again, I'm looking to get a high premium since I'm going to be doing what's called a cash secured put. Now for those of you who don't know what a cash secured put is, I advise you go back and look at my videos on cash secured put. So like I said, I'm going to go with the $10 strike price for an $87 credit. We're going to hit continue. We're going to choose the amount of contracts, which is 1, and we're going to choose our limit price. We're going to stick with Robinhood's recommendation, which is 0.87. And there you have it. Let's go to review. Good. Now in this particular case, our collateral is going to be a lot more than if we were to use the call credit spread as in the previous example, and our minimum credit is a bit higher as well. Now for this strategy, you will be receiving a much higher minimum credit and you do have to leave a lot higher collateral, but this strategy works out in 2 different ways. Now how do you win this strategy? Well, ideally what you want is when July 22nd comes around, you want MARA's price to be at $10 or above. If that happens, then you get to keep your $87 and you also get your $1,000 collateral released back to you in order for you to do this trade once again. Now, there is also another way this trade could go. If once again on July 22nd, MARA is trading at $10 or below, now you're forced to buy 100 shares at $10, which is going to be using up all your collateral, but it's not all lost. Once you now have 100 shares of MARA, then there's another strategy you can use to continue making money, but once again, that's for a different video. Please let me know what you guys think about this strategy in the comments below, and if there's any other strategy you think that could be best used during the recession and can also work if you're trading with a small account. Now, we have lots of option strategies on this channel, so if you want to join the weekly income team, like and subscribe to the channel right now. Also, hit the notification bell below to get an alert whenever I post a video. But most importantly, please share this video with someone you think that can benefit from its content. Let's help as many as we can. Remember, A salary will give you a living, but your investment gains will give you a lifestyle. Thanks for watching, and remember, always keep pushing your investments.